In this video, we're going to talk about Senseonics, trading under the ticker symbol SENS. Before today's video begins, if you would like to see more stock analysis videos on the trending stocks in the financial market, please like, comment, and subscribe to my channel for more. Senseonics is a medical startup that develops devices monitoring glucose level for people. They already have a line of products and allow patients to monitor their status in a timely manner. Their devices also connect to phone applications, so they're quite flexible and convenient. We're going to address if the current period is a good time to buy Senseonics and if it'll go higher in the month and years to come. When we look at the price action of Senseonics, there are two information that confirm each other. The first one is the overall tightening of fluctuations over the month. And the second one is the relatively bullish tendency the company has maintained since 2020. If we look at where the company was before then and where the shares are now, it is really night and day. The share price rose from around 50 cents to $4.60 in February of 2021 before pulling back to about $2. And then it began to recover from there again. Even if the price action can still prove us wrong over the next couple of weeks, the stock has a support level in the region of $3 and it may be able to hold there before enough demand pushes it higher. Nothing confirms that for the time being. So we have to wait and see over the next couple of days to determine if the $3 level is still a support. If the stock manages to hold its ground, then I believe that it'll be going up with a very high probability. On one hand, the price action may be entering in a tightening range that often ends with a major spike of volatility in one direction or another. Given that Senseonics already has quite a few promising products, and that it has been popular with the market, I don't think that the stock will be diving downward. This is why I believe that the stock will then look for a catalyst to go through its resistance levels of $4 in the short term, and then probably try to test the $4.60 level. Of course, it doesn't mean that the company will achieve these in the short term, but right now, it seems like the market has decided that the support level in the short and medium term is around $2, and that it'll not be testing this support region in the foreseeable future. I think that it'll be testing the $3 level, but if it manages to hold the ground there, then the stock may be able to go to much higher places. Another element is the attribution of stock dividends to employees. This is a relatively recent news, so the policy is a welcoming sign because not only it enforces employee loyalty to the company, but it also sends a signal that it's possible that in the short term, Senseonics stock may see its value going from $3.20 to at least $3.45, which corresponds to the exercise price of these options, and probably beyond that as well. My recommendation for Senseonics is to keep your position if you have already bought Senseonics shares, and to buy some shares to build up a position if you don't have any existing holdings in this stock, and to profit from the reasonable cheap price of the shares at the moment. I would suggest to keep your exposure at 1% of your portfolio. Looking at the current environment, I think we have to be careful about having exposures in the equity market because it has been predicted for the stock market to eventually go through a major pullback or even a recession for more than a decade at this point, and that its future outcome depends on a number of elements. First of all, after the quantitative easing years and the drastic increase in asset price and the corresponding decrease of their yields, we have to remember that the market isn't a mirror on how the economy is doing, because otherwise we would have seen a market trending a lot more sideways than upward. And then, 2020 saw another big push in asset prices, and this time not just for the blue chips, but for everybody. These are, in my opinion, the main explanations. The first one is that more money has been printed across the world, and because the real economy has been stagnating over the years. The capital then entered into the huge melting pot of globalized finance and has been buying up shares and assets ever since. That was the case for quite a while, but right now I believe that QE has been touching its end in North America and slowing down in Europe. In other words, that will not necessarily going to play an important part in continuing maintaining the stock price or even getting them to higher places in the years to come. This decrease of new money is partially compensated by the geopolitical tension across the world. And the more tensions there are, the more money tends to flow to the US and North America, because it is still perceived as a safe haven for capital from different countries, especially the ones that are currently seeing turmoil or social unrest. One last phenomenon is the attempt of market participants to protect their capital not just by remaining cash heavy, but to concentrate their purchases in a few specific sectors so that the asset price in those sectors remain high, not only due to good fundamentals, sometimes there's none, by the way, but not only to their fundamentals, but also because there's a very high level of demand. What all of these mean for the market is that the degree of uncertainty will increase over the next month and years, especially as the expectation for a recession is building up after the big party in 2020 and the recent announcements from the US Federal Reserve about the possibility of a recession in the short-term future. All contribute to a higher degree of inherent risk of owning shares. Of course, there also has been some buildup of economic difficulties coming from Asia and the potential effect that it may have on other financial markets. All these elements led me to conclude that it's very important to keep the speculative plays at a reasonable level. Normally, a healthy portfolio contains a good percentage of its positions in sectors that are not only different, but also of different class of assets. Usually they're stable with predictable cash flows, like REITs, fixed income assets, and preferred shares. The rest should then be invested in growth stocks or to stay cash heavy in a case there is an opportunity to scoop the bottom. I think that overall, the current environment does make me believe that there will be opportunities to average down your cost basis. And this is why the initial position should remain small so that we can afford to average down further as time goes on. Thank you for watching.